Good evening, everyone. Time for another silver update. You are looking at the 5-minute chart of gold. I've got a couple of lines here. One is a not a real strong trend line because it's only been tested twice, essentially. The other line that we have on the top is the 1764 price that came from James Sinclair. Now, he had said that this price is going to be similar to the 500 price that we had when we entered into a new phase of a new parabolic rise. And the prediction that he made, it's kind of interesting that the prediction price that he made, if you remember, the time when that interview was done was roughly about here, I think about 1715, maybe even lower. I don't know, you'll have to check. It could have even been down around 1700. But we had a rally where the last time I posted a video commentary was at 1754. You can see we're at the same price, and then we subsequently went and took out that high. We took it out again and went higher. We took it out a third time and then a fourth time. Now we're settling into a type of ascending flag formation. So it's hard to really tell where we're going to go from here. One of the big technical rules that a lot of people follow is a W for winner and M for murder. So it's really hard to determine where we are right now. You can look back at some of the other configurations here and you can see kind of a W here and we get a winner. We've got a M for murder here, but we've also got a W for winner here and another W for winner here and an M for murder here. So it's hard to say. We're building a lot of W's and M's in this situation. One thing to point out that is really interesting is that I don't know how many of you have been following gold for the length of time that I've followed it, but I've followed it roughly since about 1995 or so, and there was for the longest time what was called the $6 rule. And I think if you go and peruse some of Gaddis' past articles, you'll probably find a lot of references to that. And it was a pretty consistent pattern that anytime gold moved more than $6 in a day, it was smacked down. So just to give you an idea of the type of moves that we're looking at here, here's our days, okay? So this is the 9th, this is today. This is the 8th, this is yesterday, and then we've got the weekend. But you can see that we've got a move here, which is about 1650 to 1710. That's a $60 move. So that's a tenfold increase in that $6 rule that used to exist. We've got a move here from about 1692 to about 1769. So there's a $70+ move. Then we go down to 30. We go back up here. We go down from 1780 down to 1720. That's a $60 intraday move. 1720 back up to 1777. $57 move. Back down and back up again. So obviously the volatility in gold has exploded. If we pull out a little bit farther, we can see, well, we need to go a little bit farther. Let's do the 30-minute. We can see that gold has entered into a whole new era of volatility. And how the news that's come out today and yesterday and is kind of coming fast and furious. We have a nice breakout line here that doesn't seem to have failed. So we have to wait and see what this is going to do. My suspicion is that this presages a radical breakout high, something way up in here. So it very well could be the precursor of $100 moves in gold, and that's what the Patriot Radio guys, Joe and Eric, have been predicting, that you're going to see $50, $100, and $200 moves in gold, and we're really starting to see those things take shape in front of our eyes. Just something as recently as late July, right here, you can see the type of stayed trading that we have between these 2 points. So we're moving to a new level of volatility in the gold price that is something that has not really been seen before. That's to be expected because things are changing rapidly. So let's jump over to silver. Now, I'm not going to spend a lot of time on silver specifically on this update because I have a lot of things I want to say about interest rates, but we've had a lot of people who are, I'll use the term, upset that silver hasn't responded the way they expect it to. I've done the overlays with gold and silver, and people are kind of perplexed at how silver hasn't risen the way gold has in response to these news items. I've dealt with a lot of speculation as to why that's the case. I don't really care, to tell you the truth, because as I pointed out before, your reasons for buying silver are fundamental, your entry points are technical. So I'll just go ahead and give you another entry point, and that's going to be about 36. So if you're a silver bull based on fundamentals, I think if you see a 36 print, that's a pretty good buying spot. Could it penetrate to the downside? Of course it could. For the people who are new, that did not ride out this decline, and I've covered this decline many times, I've shown you my statements of where I was buying massively through this entire bottom here because I believed in the fundamentals of silver. So without believing in the fundamentals, you probably aren't going to be able to pull the trigger. So if you find yourself doubting the reasons for buying silver, then you really need to go back and study the fundamentals, because it's the fundamentals that give you the conviction to buy when the price is dropping drastically. And silver is a unique animal. It's one of those markets where you have percentage moves that are much larger than any other comparable market. So my preference, as I pointed out before, began with buying the breakout after the Buffett high, and that's when I really started buying silver. I bought silver on new highs for a number of times. I bought silver here, I bought silver here. Once we hit the March Bear Stearns, this is the Bear Stearns cap, and if you remember, the 2008 crash was marked by a move from 21 something all the way down to 8 something. So that was a huge percentage loss. That would be, we need to go down to 22 roughly to match that, or even possibly lower, somewhere around here to match that, which we could, it's possible. But it takes tremendous conviction to buy at those points. You have to believe in the fundamentals of the metal. So hopefully I've said enough about silver and why you have to buy it. I wanted to jump over to the interest rate story because it's really important that we have made the move that we have. If you watch the market closely, and I'll go ahead and pull up the Dow chart so you can see it, we were actually dropping quite dramatically right before the Fed announcement, and I didn't have time to follow them live because I was busy at the time, but we had a Fed announcement and we were dropping pretty dramatically before that. We had an up open around 200 points, and then we were down roughly 200 points. You can see the bottom at 10,600, and back in around July 20th, late 20s, we were around 12,600. So there's a 2,000 point move in roughly 10 trading days or so. But after the Fed announcement, we got a very strong rally, which is from bottom to top, roughly 639 point rally. Now, if you remember the 2008 crash in the Dow, it's hard to see here, but we actually experienced an increase in volatility, and I think I can get in closer and examine these. So, well, it won't let me move over, but I'll just go in closer so you can see. We had, this is the daily, we had days where we were dropping. Now, you had a day here where you were down to about 7,900 on the Dow, and within 2 days after that, you were at 9,700. That's an 1,800 point swing. Then about 10 days later, we're back down to 8. There's a 1,700 point swing. And then just 5 days later, we're back up here, another roughly 15 to 2,000 point swing. And then we go from about 9,700 down to roughly 74. And this isn't accurate because we know the low was lower in the 6,000s, but still you're talking about a 2,500 point swing. So when you start to enter into the volatility that we had back at this time frame, it's not unusual at all to see up 200, down 200, up 500, down 500, up 500, down 1,000. That's what you get when you start to see that type of volatility. So we're on the rally phase. I'm not at all convinced that this rally will hold. One of the reasons why is we want to look at our rounding off chart patterns. If we just take our highs and roll them down, we can see we're still rounding down to the downside. And there's the penetration right there. So we've penetrated this downside trend line, but we haven't yet penetrated this. We could easily spike, hit that, and head much, much lower. That's a very real possibility. But I wanted to get to the news that occasioned this type of thing and try to examine some of the fundamentals that are related to interest rates and how that works. So our news headline is Stocks Soar After Fed Pledges Low Rates into 2013. Amazing. The Federal Reserve offered super low interest rates for 2 more years Tuesday, an unprecedented step to arrest an economic free fall that dragged down the stock market. Wall Street roared its approval and finished a wild day with a 429 point gain. Okay, first of all, economic free fall. What was the economic free fall? Is the free fall in the stock market an economic free fall? And we're going to address that down here lower, is that we had, we're 2 years after the recession, and how can it be an economic free fall if we're still 2 years after a recession? And so that's going to give lie to the claim that they're making that we're in a free fall. So we're in a stock market free fall, but there's no evidence at all that we're in an economic free fall or we never left it. So that's kind of a questionable interpretation right there. The rally was remarkably fast. The Dow Jones Industrial Average was still down for the day with less than an hour of trading to go and enough to erase 2/3 of the decline the day before. The Fed set its target interest rates near zero in 2008 as a response to the financial crisis that fall. Since then, it is said only that rates would stay low for an extended period. So they left an open-ended period. They didn't define it. On Tuesday, it said that it would be at least through mid-2013. But the Fed also said it expects the economy to stay weak for 2 more years. Stay weak is in what kind of weak? Are we out of a recession? Are we in a recession? Obviously, you can see the Fed doesn't know what they're talking about. They've been wrong time and time again. They have a stopped clock is right twice a day. The Fed is wrong 24 hours a day for weeks on end. I mean, they're so wrong. Their credibility is completely shot. Even with their manipulation and the rest, they're just so wrong so often that you have to wonder. You can't be consistently wrong that often without it. That no coincidence can occur that often. So the Fed is startlingly wrong about everything. Longer than the Fed had previously indicated. It has already been more than 2 years since the end of the Great Recession. What does that mean? Great Recession. Well, I don't have time to go into it here, but you can look at the length of this recession, and there have been recessions longer than the officially declared recession. So how's that a Great Recession? Obviously, they're not telling you the truth. The central bank left open the possibility of a third round of bond purchases. Okay, here's QE3, designed to hold interest rates down and push stock prices up. That's an interesting admission. I don't remember them admitting before that the purpose of a qualitative easing is to push stock prices up. The second round announced last year sparked a 28% rally in the Dow through April 29th. It was an unusually volatile day of trading. The Dow was up about 200 points most of the morning. It was up about 100 when the Fed statement came in at 215. Within half an hour, the Dow was down more than 200. So you can see that the Dow fell 300 points. But investors warmed to the Fed news. Is that Orwellian speak? So the investors that heard the news and sold the Dow down by 300 points warmed to the news and caused a 640-point swing. So I'm not going to go into this too far. The whole thing stinks. It's ridiculous. And I'm going to try to prove to you, explaining interest rates, that this isn't a real market. It's a fake market. And I think that if you read between the lines in this article, it's pretty clear that they're admitting it's a fake market. So let's look at the interest rates. The yield on the 10-year Treasury bond briefly hit a record low of 2.03% and finished at 2.26%. Investors have bought U.S. debt, driving down yields even after S&P stripped the United States of its top-of-the-line credit rating last week. Okay, so we know that the bond hit 2.03% and then finished at 2.26%. That's a 10% rally. From 2% to 2.26%. That's a 10% rally in interest rates. That's also a 10% decline in the price of bonds. So they say investors bought U.S. debt, driving down yields. No, yields rose 10%. So this stuff is so much garbage that it's a waste of time to even analyze it. It's just nonsense. So let's look over at interest rates and try to get an idea of what we're talking about here. So let's cover some basics. This is Wikipedia's article on the interest rate and how you understand it. I'm going to drop down real quick and look at the risk part. The level of risk in investments is taken into consideration. This is why very volatile investments like shares and junk bonds have higher returns than safer ones like government bonds. Okay? So if you remember, one of the latest controversial stories to come out is that the S&P rating service downgraded U.S. sovereign debt from AAA to AA plus, or whatever that is. Now, the extra interest charged on risky investments is known as the risk premium. The required risk premium is dependent on the risk preference of the lender. And they give an example here. If an investment is 50% likely to go bankrupt, a risk-neutral lender will require their returns to double. So for an investment normally returning $100, they would require $200 back. A risk-averse lender would require more than $200 back, and a risk-loving lender less than $200. Evidence suggests that most lenders are risk-averse. Wow. Who are the editors of Wikipedia? Those are some dumb people. But anyway, let's look at the bond credit rating, because that's the news story that we're following, and I wanted to really dig into this issue. Okay, so here's your three big guys: Moody's, S&P, and Fitch. And here's how their ratings work. They have their own stupid little system. With Moody's, you have big A and two little A's. With S&P, you have three big A's, and Fitch is three big A's. The next step down is AA1 for Moody's, and AA plus for S&P, and AA plus for Fitch. So these two matches. This S&P downgrade was a downgrade of sovereign U.S. debt from AAA to AA plus. So this is the downgrade you got. These two, Fitch and Moody's, left it the same. So that's the situation we had with the sovereign downgrade on U.S. debt. We have a lot of, and here's the definitions. So these line up with each other. The rating that we had with Standard & Poor's before this happened, Thursday, before Friday's downgrade occurred, an obligor has extremely strong capacity to meet its financial commitments. The downgrade brought us to an obligor has very strong capacity to meet its financial commitments. So we went from extremely strong capacity to very strong capacity. What does that mean? What does all this mean? Well, you have to think about it intuitively to understand it. First of all, why do you have a bond credit rating in the first place? We've already looked at interest rates. Aren't interest rates the market's credit rating of bonds? We already looked at the definition of risk and the example. If a bond is perceived as risky, its interest rate will be higher. If a bond is perceived as safe, its interest rate will be lower. So the market already sets the rating of bonds. It's the interest rate. That's the free market. So the question arises, why do you need bond ratings? Well, if you remember back in 2008, with the CDOs, the CDS, all the alphabet soup derivatives that went from AAA prime to zero. These bonds are on the Fed's book right now. The Fed bought them. They went from the top to the bottom. Why? Well, you have to go back farther and ask yourself, if you have an interest rate that is the free market determination of the risk of a bond, why do you need rating agencies at all? You can just use the interest rate. So something else is afoot here. And, of course, what's afoot is corruption. There are pension funds and mutual funds, but primarily pension funds, such as public employees' retirement funds or trust accounts or ERISA retirement accounts, that all have requirements that their investments be graded above a certain grade. Well, the natural question would be, why would they want them to be graded a certain grade? Why not just set a certain interest rate and leave it at that? So they can't be above this interest rate or they're not safe. Well, because they needed to cheat the system, because the Fed, and we have to go back to the Fed was setting interest rates at ridiculously low prices. Let's get back to our article here. So the Fed was pegging interest rates at unrealistic, stupidly low interest rates. Because, and I'll have to go into another video of how the Fed targets not only short-term rates but also long-term rates. So the Fed, so the Fed was targeting rates at an unnatural low rate, and investors would seek a yield. I'm sorry, I have a frog in my throat. So investors would seek a yield that was higher than this targeted Fed rates. And the only way they can invest in these higher rates, essentially junk product, was to get a rating on that to make it okay. So this whole rating game is a fraud, and it was exposed as a fraud when the AAA bonds of the various MBS, CDO, CDS squared type of bonds went bust. They went from AAA, they were bought by, Norwegian municipalities and, foreigners, etc. They went straight from AAA to bust, and the Fed had to buy a bunch of them because it was a scam. So again, the Fed is targeting rates low. They're pledging the money to buy up these really worthless bonds. And the question that remains, and I'll finish on this, is that even though the Fed has targeted the short-term rate to a 2-year pledge of keeping it low, we've already seen that this is near zero. So the Fed can target that rate because it controls the short end of the yield curve. But the question remains, how does the Fed target the long-term end of the yield curve? And as this points out, we dipped down to 2.03% on the 10-year. We finished at 2.26%. And for the Fed to keep this rate down, it means the Fed has to buy long-term bonds. So a lot of people have stated that the Fed doesn't have the power to set long-term rates. I don't agree with that. The Fed has the power to set long-term rates and short-term rates. It can peg the short-term rates, and it just simply prints the money to buy the long-term bonds and suppress the yield. So this dramatic move today shows that the Fed has a target of 0% interest rates, that their Bernanke helicopters are still ready to roll, that the Fed is prepared to print as much money as is necessary to prop up the markets. You don't have a real market. You haven't had one for a long time. That's why you need bond credit rating, because it's a fake market. Gold sees this. Gold knows this. And if we look at the gold chart, we can see that gold is starting to trade in a dramatic, volatile fashion, and the range is expanding. So gold's going to explode to the upside. When gold explodes to the upside, we know that silver is going to follow. And silver is a monetary metal, even though the powers that be are trying to convince us it's not. It is. Gold only needs to break so far higher, and then silver will catch up and surpass it. So I've had some people criticize me for saying I have a $100 price target. Let me clarify. I have a $100 price target for the end of this year. I have a $100 price target for the beginning of next year. And that's going to be January 1st. And we'll talk to you next time.